So in this video we will be discussing the concept of operating leverage. Operating leverage is the extent to which fixed costs are used in a firm's operations. In business terminology, a high degree of operating leverage, other factors held constant, implies that a relatively small change in sales results in a large change in return on equity. This is telling us that high fixed costs means that the operating leverage of the business is high, which implies a high business risk. So you have two types of costs. You have variable costs and you have fixed costs. If a business has high operating leverage, that business will have a higher proportion of fixed costs relative to the variable costs. And this higher proportion of fixed cost would mean that even a small change in sales results in a large change in return on equity. Now, why is this bad? Why is this risky? This is risky because this might mean that a 1% decline in sales can cause a 20% decline in your return on equity. You can see such a big difference, a magnitude of difference, because maybe this business has a high proportion of fixed costs. That's why high operating leverage means high business risk, and a low operating leverage would mean low business risk. We will discuss this in more detail through an example, but before we do that, we need to revise the formula for operating break-even, which is your break-even point. Break-even point is that point where your earning before interest and tax is zero, your operating profit is zero. So the formula to calculate this will tell you the output quantity where you break even. Q stands for quantity. So this is the break-even quantity. It means if you sell these many units, neither will you make profit, neither will you make loss. Your EBIT will be zero at this point. F over here stands for fixed costs. P is the selling price and V is the variable cost per unit. So now we have two plans, plan A and plan B. The price in both cases is the same, but plan A, we can see that the variable cost is higher than plan B, and the fixed cost is lower in plan A and it's higher in plan B. The assets are 200,000 in both cases and the tax rate is 40%. So if we calculate the break even in units for both of these, plan A and plan B, we can calculate it. So thus for plan A, the fixed cost was 20,000. So the formula for this was fixed cost minus selling price minus variable. So the fixed cost for plan A was 20,000, selling price was 2 and the variable was 1.5. So this means 40,000 units. According to plan A, if the business produces 40,000 units, they will break even. And for plan B, the fixed cost was 60,000, the price was 2 and the variable cost was 1. So for plan B, at 60,000 units, the business will break even. So you can see that for plan B, where the fixed cost is higher, the break even point is also higher. And where the fixed costs are low, the break even point is automatically low. So now we will try to make a graph out of it. So let's do it for plan A first. So looking at plan A, the fixed costs are 20,000. So you can see that they are somewhere around here. This horizontal line is the fixed cost, because it will not vary with the level of production. So whatever the sales, the fixed cost will have to be paid. The green line over here is the sales revenue. So as the sales, the number of sales increase, the sales revenue amount will increase. And from here you can see these are the total operating costs. The red line is the total operating cost, because variable costs are added to the fixed costs over here. The difference over here, this difference is all representing the variable cost. As the units of production increase, so does the variable cost. So as your variable cost increases, your total operating cost increases. Now if you look at plan A, the plan A is going to break even at 40,000 units. And over here you have operating loss, and on this side you have the operating profit, because over here sales is greater than the total operating cost. The green line is above the red line, whereas over here the red line is above and the green line is below. So over here the business is unable to cover its total operating cost. The operating cost is more and the revenue, the green line, is lesser. So at this side you have loss, at this side you have profit, and this is a break even. Over here you are just covering your costs. You're not making any profit at this point. This is the break even point. This is plan A and this is plan B. So for plan B you can clearly see that because the fixed costs are more, it takes more units to break even. So plan A breaks even at 40,000 units, but for plan B they need to produce at least 60,000 units before they can break even. So till 60,000 units they are unable to cover their operating costs. They are in loss in this region, which is a larger region compared to your plan A. And over here the green region is your operating profit in this case. Because the fixed costs are more, the break even point takes time over here, whereas because the fixed costs are low over here, the business will break even quickly. So they will break even at 40,000 units, whereas they will have to sell 60,000 units before they break even, before they start to make a profit. So clearly plan B has more risk compared to plan A. So continuing with the hypothetical example, now this is a table. Over here you have the data for plan A and over here you have the data for plan B. On this side you have the demand, so terrible, poor, normal, good, wonderful. So there are different probabilities attached with each demand, and based on that there will be different units sold and there will be different dollar sales. Based on this, they have calculated what will be the net income for plan A and what will be the net income for plan B. So we're interested in the fluctuations. The fluctuations can be seen from the standard deviation. So you can see that there is a 7.41% standard deviation in return on equity for plan A, whereas there is a 14.32% fluctuation in return on equity based on plan B. So remember, plan B was a plan which had higher fixed costs, and over there you can see that fluctuation in your sales is causing a high fluctuation in your return on equity, a 14.32% standard deviation, whereas it is causing a lower amount of fluctuation in your plan A. So when the proportion of fixed cost is less, this proves that the business risk will be lesser in that case. Now this is a practice question 14-1 from your book. Company's fixed operating costs are 500,000, its variable costs are 3, and the product sales price is 4. What is the company's break-even point? That is, at what unit sales volume will its income equal its cost? So you can use the break-even formula for that. The fixed operating costs will be 500,000. selling prices 4 and 3. So the number of units at which the business will break even is 500,000. So at 500,000 they will neither make any loss, neither they will make any profit. They will just cover their expenses. Their EBIT will be 0 at this point. Now, to what extent can firms control their operating leverage? The answer is, to a large extent, operating leverage is determined by technology. So, electric utilities like telephone companies, airlines, steel mills that are more capital intensive will have higher fixed costs, and because of that they will have a higher operating leverage. Now, higher operating leverage means that a small change in sales will have a large change in return on equity over here in these businesses, whereas grocery store service businesses will generally have significantly lower fixed costs because these are not that capital intensive. So, because their fixed cost will be lower, their operating leverage will be lower, which again means that now a change in sales will not have that much of an impact on your return on equity. So, the business risk is less over here.